Are we looking at a falling trend, glaring sell signals, or a strong buy that some are still calling undervalued? Let's unpack this.
Yeah, I mean, it really is the ultimate market tug of war right now.
Right, because today, the market is staring at a stock that is basically bending the laws of financial gravity.
It completely is. On the fundamental side, you have this undeniably historic, like world-changing momentum. But then on the technical
Your
side,
dashboard is flashing red.
exactly, we've got several flashing red warning lights that we simply cannot ignore.
Well, welcome to the deep dive. If you're joining us today, you already know our mission. We are tearing through a massive stack of sources, financial statements, technical indicators, analyst ratings, to figure out exactly what is happening with Broadcom Inc.
Ticker symbol AVGO.
Yep, AVGO. And as of today, Tuesday, April 21st, 2026, the stock is sitting at $398.58.
Which is, a really fascinating crossroads.
Hmm?
Because we are looking at a company driven by incredibly strong bullish momentum, but at the same time, it's navigating some serious technical exhaustion.
Yeah, it's a lot to process. Quick ground rules, though, before we get into the heavy data. This deep dive is for educational and entertainment purposes only.
Right. We are definitely not giving financial advice.
Absolutely not. We're just analyzing the landscape. How you trade your portfolio is entirely up to you. Also, consider this your compulsory but very friendly toll for the journey. Hit that like button, subscribe to the YouTube channel, and leave your thoughts in the comments.
Yeah, please do.
We are looking at some wildly debated metrics today, and we genuinely want to hear where you stand on this whole Broadcom debate.
So let's zoom out a bit and just look at the sheer scale of this situation.
The scale is honestly what first caught my attention. When you look at the 52-week range, I mean, it is staggering.
It really is.
In a single year, Broadcom has swung from a low of $161.61 all the way up to $414.61.
That's a massive move.
It is. That isn't just normal market volatility. That is a fundamental repricing of a company that was, already a titan. When a massive legacy tech giant triples in a year, you have to ask how.
Right. And to answer that, you really just have to look at their fiscal year 2025 revenue print. It's like a blockbuster movie that just keeps grossing more at the box office. Yeah. They hit $63.89 billion in annual revenue.
Okay, let's unpack this for a second. How does a company actually pull in almost $64 billion in annual revenue?
Well, the growth is just aggressive, particularly when you look at the fourth quarter, which it pulled in $23.13 billion on its own.
Wow, in just one quarter.
Yeah. They essentially matched their entire annual net income, which, by the way, was also $23.13 billion, with just their top-line revenue from the final 3 months.
Sure.
Oh, and Q4 net income alone is estimated around $2.4 billion.
That's wild. But, the massive gross revenue isn't actually the most impressive part of the income statement to me.
Oh, you're talking about the margins.
Exactly. Because, look, any company can boost revenue if they spend recklessly to acquire it. But their efficiency is what stands out. Broadcom reported an annual gross margin of 67.8%, holding steady right into Q4 at 67.9%.
Which is almost unheard of for a hardware company.
Right. In the traditional semiconductor hardware space, maintaining nearly 68% margins at a $60 billion scale is notoriously brutal. I mean, the costs of fabrication, raw materials, supply chain logistics, all of that usually drags that number way down.
Yeah, and that is exactly why Broadcom isn't just a hardware company anymore.
The VMware deal.
Bingo.
Yeah.
To understand how they engineered those margins, you have to look at the VMware acquisition. They essentially hacked their own corporate DNA.
How so?
By bolting an enterprise software giant onto a legacy hardware business, they completely transformed their profitability profile.
Because software scales, fundamentally differently than hardware.
Exactly. When you're selling physical silicon, every single chip requires raw materials, manufacturing time, shipping. It costs real money. But software scales with near zero marginal cost.
Right. You build the virtualization platform once.
Yes, and the margins on the millionth enterprise license are phenomenal. So when Broadcom walks into a major client now, they aren't just selling the networking chips. They are selling the entire virtualization software layer that runs the data center.
And the high margins from that VMware side effectively subsidize the massive capital expenditures required to keep their AI silicon cutting edge.
You nailed it. And you can see the results of that strategy sitting right there on their balance sheet. They're holding total assets of roughly $171.09 billion.
Compared to what in debt?
Against $65.14 billion in total debt.
To put that $171 billion into perspective for everyone listening, their asset base is larger than the GDP of several mid-sized countries. It's huge.
It is. But the number that I find absolutely fascinating is the free cash flow. $25.04 billion in free cash flow for the year.
With $7.47 billion of that in Q4 alone.
Yep. And why should you care about free cash flow? Because a $25 billion war chest changes how a company operates on a systemic level.
It's an incredible safety net.
Exactly. With that much free cash flow, Broadcom doesn't have to worry about borrowing at premium interest rates if the macroeconomic environment sours. They have the internal capital to just relentlessly outspend competitors in R&D or aggressively buy back stock.
Or just acquire emerging threats before they even become a problem.
Right. It provides an operational shock absorber that pure-play startups simply do not possess.
Okay, but let's play devil's advocate for a minute.
Sure.
Because everyone slaps AI on their pitch deck these days just to juice their stock price. If I'm looking at Broadcom from the outside, they are fundamentally a networking and chip company. Where is the actual impenetrable AI moat here? I mean, beyond the buzzwords, what are they actually doing?
The moat is built directly into the physical architecture of modern AI data centers. Like when people think of AI, they envision the GPUs, the graphics processing units doing all the heavy computational lifting.
Right, the Nvidia chips of the world.
Right. But think of a massive data center like a commercial kitchen. You've got, say, 10,000 highly skilled chefs.
Okay, and those are your GPUs.
Yes. And they are all trying to cook a massive, highly complex banquet at the exact same time.
I see where this is going. If those chefs can't communicate instantly, they just bump into each other, drop the ingredients, and burn the kitchen down.
Precisely.
Yeah.
It's total chaos. The GPUs are virtually useless without a flawless underlying system coordinating their movements. And that's where Broadcom comes in. They dominate the market for high-end Ethernet switches.
The plumbing.
The plumbing. These switches are the critical junctions that allow tens of thousands of GPUs to talk to each other at blinding speeds. If a tech giant is building a multi-billion-dollar AI cluster, the networking infrastructure is the single most critical bottleneck.
Right, because if the data cannot travel between the chips efficiently, that massive GPU investment is just sitting there idle.
Exactly, you're just burning electricity for nothing.
Okay, so they own the plumbing of the AI revolution, that makes sense. But they also build the custom accelerators themselves, right? Because hyperscalers like Google and Meta aren't just buying off-the-shelf hardware anymore.
Yeah, they are actively moving away from one-size-fits-all hardware. Broadcom co-designs custom silicon, specifically ASICs application-specific integrated circuits.
Custom built for a company's proprietary algorithms.
Yes. Google's tensor processing units, the TPUs, are the perfect example. A standard off-the-shelf chip is great at handling a wide variety of generic tasks, but it's expensive and consumes a massive amount of power.
Whereas a custom ASIC.
Custom ASIC designed by Broadcom is stripped of all unnecessary architecture. It executes one highly specific AI workload incredibly efficiently.
Which saves the client massive amounts of electricity and cooling costs.
Exactly. That is the core bull case right there. The best case recovery and growth scenario is that Broadcom remains this indispensable partner, deeply embedded in the hyperscalers' infrastructure.
It is a phenomenal bull case. But, we know there are cracks in the armor. We're seeing significant softness in their legacy non-AI segments.
Yeah, that's the other side of the coin.
If we look at their traditional business things like broadband connectivity, wireless chips, enterprise storage, it seems like the hyper-growth of the AI division is just providing a smokescreen for stagnation elsewhere.
It absolutely is providing cover. The legacy semiconductor markets are highly cyclical, and right now they are dealing with industry-wide inventory gluts. Demand is just soft.
But the stagnation in broadband isn't the most existential threat to the stock price, is it?
No, it's not. The real risk, the bear case, comes from direct competition in that highly lucrative custom silicon space. Marvell Technology is actively and aggressively moving to take market share.
And Marvell isn't just some peripheral player.
Not at all.
They are directly targeting those exact hyperscaler supply chains. If Google decides to leverage Marvell to dual source their TPUs, or if Broadcom loses even like 10 or 15% of that custom workload to a competitor, the narrative changes overnight.
That represents the worst case, continuation lower scenario for the stock. Broadcom's current premium valuation relies heavily on the assumption that they will maintain a near monopoly status in high-end AI networking and custom ASICs.
So if Marvell breaks in,
any concrete headline suggesting Marvell has secured a significant piece of Google or Meta's next-generation silicon would shatter the illusion of invulnerability. it would trigger an immediate repricing.
And honestly, that fundamental threat perfectly explains the severe anxiety we are seeing on the technical charts right now.
Well, the charts are stressed.
Yeah, because while the core business looks incredibly solid, the stock itself looks completely exhausted. When we pull up the technical indicators, the relative strength index, the RSI, is ranging between 73.98 and a staggering 94.16.
Which is wild.
Yeah.
An RSI rating consistently in the 90s is incredibly rare for a company of this market cap.
Right, it's like a car's tachometer. If the RSI is between 73 and 94, we are redlining the engine. The car's going incredibly fast, but it might need a breather soon.
That's a perfect analogy.
Yeah.
It indicates relentless, near-euphoric buying pressure over a very compressed window. The stock has accelerated so far and so fast that it is technically overextended.
And historically, you just can't sustain that.
No, an asset cannot sustain that level of vertical movement without a consolidation period. The buying pressure eventually just exhausts itself.
Yet the trend hasn't officially broken.
Sure.
The MACD, the moving average convergence divergence, is sitting at a positive 3.190, which confirms that the underlying bullish momentum is still technically present.
Yeah, the momentum is still there.
Plus, the 50-day simple moving average is hovering around $388.15, which is towering over the 200-day average, way down at $338.33. I mean, the moving averages are screaming strong buy, even if the RSI is redlining.
Right.
So, looking at the chart, where are the actual battle lines drawn between the buyers and the sellers?
We have very clearly defined zones right now. The technical floor, the critical support zone, where institutional buyers historically step in, sits heavily between $309.76 and a deeper safety net at $294.52.
Okay, so that $300 to $330 range.
Exactly. The trading volume profile shows massive accumulation in that $300 to $330 range. That is where the smart money built their foundation.
And on the top end.
Conversely, on the upside, we are slamming into firm, heavy resistance starting at $406.55 and stretching up to that 52-week high of $414.61.
Which brings us to a crucial dynamic that we really have to discuss. It's the danger zone for individual investors, the retail trap.
Oh, yeah. This happens all the time.
We see this mechanical cycle play out constantly in high momentum tech stocks, and it is devastating for people trading purely on headlines. How does that trap actually work here?
Well, the mechanics of the retail trap are driven entirely by human psychology and poorly timed execution. Remember that $300 to $330 support zone we just mentioned?
Yep, where the smart money accumulated.
Right. That is where institutional investors quietly built their core positions months ago. They recognized the AI infrastructure thesis before it hit the mainstream news cycle. So eventually the stock rips upward, crosses the $400 threshold, and suddenly it's dominating the financial networks.
And that is exactly when the retail trader experiences severe FOMO.
Yes, they see the stock hitting new highs every day. They hear about the AI supercycle on TV. They buy in right at the $410 to $414 resistance zone.
They are buying exactly when the RSI is screaming that the asset is wildly overbought.
Exactly. And importantly, who do you think they're buying those shares from?
The institutions.
Yes, they are buying them from the institutional investors who are using that sudden wave of retail liquidity to quietly rotate out and take massive profits.
Wow.
Once the smart money finishes selling, the buying pressure evaporates. The stock hits that $414 ceiling, fails to break through, and naturally pulls back to cool off its technical indicators.
Leaving the retail investor instantly trapped underwater.
Right, holding a losing position at the absolute top while the institutions just patiently wait to buy the dip back down near $330.
But that retail trader panic actually highlights a massive disconnect on Wall Street right now. Because while the charts are flashing severe technical exhaustion, the analysts covering the stock are looking at a completely different reality.
Yeah, the analyst ratings are pretty wild.
We have 48 professional analysts covering Broadcom. Out of those 48, there are absolutely zero sell ratings.
Zero.
The consensus is overwhelmingly a strong buy. Here's where it gets really interesting, though. How can a stock with a PE ratio of 77.96 be considered a strong buy? Are these analysts seeing an undervalued gem, or are they leading people into a massive value trap based on historical norms?
This is the absolute heart of the valuation debate right now. By any traditional historical metric, a price-to-earnings ratio approaching 80 for a hardware-centric technology company is a glaring, massive red flag.
Right. Value investors look at a 78 multiple and see a textbook value trap.
Exactly. They see a bubble ready to burst because you're paying an astronomical premium for earnings that have already occurred.
Yeah, if you were analyzing a traditional industrial company or a consumer goods brand with those metrics, you would run for the hills.
You'd be terrified. But these 48 analysts aren't using traditional historical models. They are focusing entirely on Broadcom's projected revenue growth, which currently sits at a staggering 47%.
Ah, so they're betting on the future.
Because the stock market fundamentally prices in the future, not the past. The analyst community is making a very specific, aggressive argument here. They believe that the compounding cash flow generated by Broadcom's near monopoly in AI networking, combined with the massive margin expansion from integrating VMware, completely breaks the traditional PE rulebook.
So they think the future growth justifies the current price tag.
Yes, they're betting that Broadcom's future earnings will grow so aggressively that it will quickly compress that 78 PE down to a highly reasonable multiple over the next few quarters.
So it is the ultimate growth versus value showdown, just supercharged by the AI narrative.
Basically.
The bulls argue that you are paying a premium today for tomorrow's indisputable dominance in data center architecture. But the bears look at the softening legacy broadband division, the aggressive Marvel competitive threat, and that overextended RSI. And they argue the stock is priced for absolute perfection in a highly imperfect world.
And that profound disagreement means the short-term outlook is going to be intensely volatile.
When's the next big catalyst?
We are heading into a major event horizon, with Broadcom's next earnings report scheduled for June 3, 2026. If the bullish momentum breaks before that report, given the severe technical exhaustion we just discussed, a short-term fade to retest that $330 support level is a highly probable scenario.
But the long-term structural perspective is a completely different conversation.
Entirely different. Regardless of how the stock price fluctuates over the next few months, the underlying fundamental demand for AI infrastructure is enduring.
Right.
As long as the global tech industry continues the race to build larger, exponentially more complex AI models, the demand for Broadcom's Ethernet switches and custom ASICs will remain a structural necessity. They are the bedrock upon which the next decade of technology is being built.
We've covered a massive amount of ground today. We looked at the scale of their $25 billion free cash flow, the margin expansion from the VMware integration, the competitive threat from Marvell in the custom TPU space, and the mechanics of the retail trap right there, the $414 resistance level.
It's a complex picture.
It really is. But before we wrap up this deep dive, I want you to chew on a completely different scenario.
Oh.
Yeah. We are currently valuing Broadcom on the assumption that AI models will perpetually require more massive, power-hungry data centers to train. But what if the next massive breakthrough in artificial intelligence isn't about raw scale?
That's an interesting thought.
Right. What if the algorithms themselves become exponentially more efficient, requiring significantly less physical hardware to achieve the exact same results? If the AI industry suddenly pivots from brute force infrastructure scaling to elegant algorithmic efficiency, does Broadcom's primary superpower suddenly become obsolete?
That would change everything.
Are we aggressively pricing in a permanent, never-ending infrastructure build-out that actually has a finite finish line?
That is a fascinating structural risk, and honestly, it is something the broader market is entirely ignoring right now.
Well, we want to know where you stand on this. Drop down into the comments and give us your take on the Broadcom valuation debate. Is it a strong buy or a value trap? And let us know what you think about the future of AI hardware demand.
We read all of them.
We do. And while you are there, make sure you hit the like button and subscribe to the YouTube channel so you never miss out on the analysis. As a final reminder, nothing we discussed today is financial advice. We simply analyze the data on the table. Thanks for joining us, and we will see you on the next deep dive.